All right, everybody. Hey, Mike, how come I'm not seeing my picture up there, Mike? What's going on, everybody? Can everybody hear and see me? Let me know in the chat here. Happy Monday to everybody. Thank you, Justin. Appreciate the smash. Like, smash away. Awesome. Awesome. All right, everybody. So today, this is what you guys asked for. There's the question that comes up all the time of how does my order get processed? What happens when I hit the send button and it goes into cyberspace? So that is what we are going to do today. Now, before we get started with that, let me just give you a quick market update here. Market trying to get back, some from Friday. S&Ps are up moderately, 13, 14 points. NASDAQ's up about 0.5%. Dow is really right at the flat line. And gold continues its run. Now, I know we took a short in gold today. Again, like I talked about this morning, it's not because I do not believe that gold is moving higher, but it really has come a little fast too quickly, in my own opinion. So that's why we took this short, and we'll see what happens. It's a limited risk position. We will see what happens. So with that being said, I want to invite in this gentleman right here, Scott Sheridan. Hey, Scott, thank you so much for being here. Really, really appreciate it. Many people, and this is certainly not anything about Scott, but when you think of Tasty Trade, Thinkorswim, you think of Tom Sosnoff, as you should be, but many people don't know that Scott was just as instrumental, just as important in forming Thinkorswim and Tasty Trade. Scott is the CEO. He's been there from the get-go. He's a former trader on the floor. In fact, going way back, Scott, Tom, and I were all on the floor at the same time. And these two gentlemen had the foresight before really anybody else. The foresight, the smarts, the intelligence, everything to build a game changer. Not many times you guys, we all get to meet someone so influential in what we do on a daily basis. And you are with this gentleman right now. So Scott, how you doing?
I am great. Thank you for that wonderful introduction. I need to walk around with you more often. You're a good wingman. So I have to say a couple of things. One, great introduction. I don't know if I was hearing, if everybody could hear Earth, Wind, and Fire. Love Earth, Wind, and Fire. I went to see The Who last night. I was a little nervous. I have a self-imposed moratorium that I don't do the old people anymore.
How were they?
Amazing. Flat out amazing. I mean, Roger Daltrey's 81, Pete Townshend's 80, and they killed it. Do they sound like they're 30? No. But was it a great show?
Doesn't matter.
Does not matter. So I have a funny story about, Tom is the rock star in this business, and he is. Tom's absolutely amazing. Tom's Mr. Outside, I'm Mr. Inside. So I run, I run the operation, I run the trading side of the business, and that's why hopefully I'm going to be able to help, your customers learn some stuff today. So let's just get into it and say, tell me where you want to go, and let's try to get some, clarity for people as to what actually happens when they hit that confirm and send, regardless of what firm they're at, what happens.
Yeah. Awesome. Let's do it. Just really quick, guys, Scott and Tom, 1999, they co-founded Thinkorswim. Okay. Nothing like that ever before. They wound up selling it to TD Ameritrade. Everyone thought they were going to run off into the sunset, and that would be the end of it. And no, that was not the end of it. That was absolutely not the end of it. So what they did instead of retiring is they just made it bigger and better. And here we are with Tasty Trade, Tasty Live, and these guys just honestly are phenomenal. So I don't know if you can all see on the screen or not. There we go. Question is that Scott is going to talk about right now. Why is my order not right? And again, as Scott said, it's not just on Tasty or Thinkorswim. It's on any platform, right? What happens when you send your order out, right? What happens if you're the first person in the world that sends that order out, but you're still not getting filled, right? It's up in cyberspace somewhere. So Scott is the only person in the world, I believe, that really knows the answers to this. So it's all yours.
Well, thank you. I appreciate that. I don't think I'm the only person, but I have to say I've covered so many sides of this business that I do have a good balance. So it is such a commonly asked question. You know, you hit the confirm and send button, what happens? Now, when we started Tasty, I did something like this for our devs because I was talking to our CTO and I said, they would have normal meetings every Thursday. Somebody would come present. I said, why don't I present what actually happens when somebody hits the confirm and send button? Because they're building the software. My guess is they have absolutely no idea what's going on. So for us, if you route a marketable, not market, but a market, I don't like market orders, so we'll just take that aside. But if you route a marketable order, but it's when you hit confirm and send, and then you hit send for that order to go through our servers, and I'm assuming this is true for wherever you are trading, it has to go through the servers, make sure you have the money to make the trade. Then once they say you have the money to make the trade, it then gets sent out to an aggregator. From an aggregator, I'll get into that. From an aggregator, it goes to an exchange. From an exchange, gets filled, comes back, goes back through the aggregator, and then comes back to us. That whole process is about 200 milliseconds, which is just mind-numbing. Scott, you and I could go back and tell stories from the 80s, and again, I think this is actually very important for this conversation. Depending on how long somebody has been trading, maybe they leg into trades, maybe they just do spreads. I'm a believer that you do your spreads because there's big advantage to doing spreads. You're giving up less, et cetera, et cetera. But today, and even if you're trading on this, the technology on a phone today is so good that you can actually send orders really quickly if you're choosing to leg in. Now, in the 80s, and sorry, I'm dating us, Scott, but you would call into a wire room, your broker. The broker would go to a wire room. The wire room would call it to the floor. The floor would give it to the runner. The runner would run it out to the pit. Depending on if he ran into a cute girl along the way, it could delay the order by 5-10 minutes. and then all of a sudden, it takes you 2-3 hours to get your order back. Well, you couldn't leg an order because you're sitting there for 2 or 3 hours. People now are saying, wait a minute, my order's been in there for 3 seconds. I'm not filled. So it's like when I talk to my kids and they're upset that an Amazon package didn't come when they ordered it an hour ago.
Instant gratification.
Like, instant gratification. Again, when we were kids, Columbia Music, et cetera, you get something you order, it would take 6 weeks.
Right.
And you'd be like, oh, that's cool. I got something in 6 weeks. So I'm going to speak from my time at Thinkorswim because that's the way it was. I can't tell you this is still how Schwab is doing it, but I'm guessing that if I'm off, I'm not off by a lot. It's in the details. But I'm going to definitely speak on behalf of how things are done at Tasty. Regardless of where you're trading, I'm comfortable saying that this is going to be 99.9% of the way there for you. So some firms, we don't. Some firms allow a customer to direct where an order is going. We don't, and for the very simple reason we don't allow it, the simple reason is if you direct an order, an exchange can protect that order. So let's talk about this. One of the best things about options trading that most people don't realize is that options are fungible. So what that means is that it doesn't make a difference where you put your order in, what exchange it fills on. When you want to get out, it doesn't make a difference what exchange that goes to. That was not the case back in the 80s. Scott, you were around for sure. You had the P-Coast, you had the CBOE. Yep. So IBM, if you were trading IBM, it was only on the CBOE. If you were trading Microsoft, it was only on the P-Coast. Well, if you're a market maker trading in IBM, and somebody comes in and buys 1,000 lot of calls, that person has to come back in and sell those calls to you again. And guess what? You're going to move your market a little bit based on when they come in to sell. That's not the case anymore. What they did was they multi-listed, the OCC multi-listed, the SEC multi-listed all, I don't want to say all options, almost every option.
Close,
Yes,
yeah.
there are CBOE prop products. There are a handful of prop products, but let's take those out of the equation for right now. I'm talking about multi-listed, which covers pretty much the entire options universe. So what happens is market makers will be on various exchanges. Now, who are the market makers today? Scott was a market maker. I was a market maker as an independent. That's a dying art. There are probably a couple left, but not a lot. When you can do everything you can do right now, and the advantage of doing what you're doing versus being a market maker, you guys, I trade as retail. We get the advantage of picking and choosing when we want to make a trade. Whereas as a market maker, you have to respond. You're always on defense because you don't know, is somebody coming in to buy calls? Are they coming in to sell calls? Are they coming in to buy calendar, sell a calendar, whatever they're doing, you're on the other side. Yes, you do get a little bit of edge on the bid-ask spread, but you're taking down what somebody else wants to do versus, hey, here's what I think I want to do. No, you could hedge your position. But today, most of the market making is done by what are called aggregators. Now, what's an aggregator? I'm going to say there are 5 big ones. One just left. Citibank was in the business. They got out. But you have Citadel, which is Ken Griffin prior to them. You have Susquehanna. You have IMC Dash. You have Wolf. There are some smaller players, but those are the big players in the aggregator game. Now, what does an aggregator do? An aggregator allows us, rather than connecting, and it can change every once in a while. It can change, but right now I think there are 16. Scotty, do you know, is it 16 listed exchanges? I think. Okay,
which is mind blowing in and of itself.
Mind blowing. So you have 16 listed exchanges. So I'm jumping around here. With options, because they're all connected, there's something called NBBO, which is National Best Bid or Offer, which means when you send an order to an exchange, you cannot be traded through. A single option, not a spread, but a single option. You cannot be traded through. So if you send an order and it goes to the CBOE and your order is to sell a call at $2 and every other exchange is out at $2, or some order goes in to pay $2 at one exchange, they don't have enough, they will go take your order from the CBOE. Only and only if you did not direct the order. If you directed that order, the CBOE could say, no, we're leaving this because Scott said he wanted the order working on the CBOE. I don't like that. That's why we don't allow people to direct orders. Now, I couldn't be traded through, but I could be traded around. So what an aggregator will do is they connect to all the exchanges so we don't have to. Now, again, I want to be careful when I say we, being Tasty. This is true for all the firms. So whether you're at Webull, Robinhood, Fidelity, Schwab, TradeStation, go ahead, name it. It's all going to be the same thing. They're all going to connect to an aggregator. There's a variety of aggregators. We have, and I believe most firms, you could ask them how they do it. I would think they would tell you, but we have a random wheel, meaning it's an algorithm that we use. And we do have requirements, regulatory requirements that say we have to monitor the quality. It's called best execution because we have to protect customers to make sure the customers are getting the best fills that they can possibly get. So in whatever firm, if you're not with Tasty, I'd love you to be with Tasty, but if you're not, wherever you are, same thing. They've got best X. So we have to monitor to make sure these firms are doing what they're saying they're doing, which is protecting the order and handling the orders correctly. So we have a system that our CTO tried explaining it to me, and I'm really good with math, and this was way over my pay grade, as to see how the randomness of the wheel works. At the end of the day, at the end of the trading session, the orders will go to our aggregators on whatever percentage, and we're pretty close on a percentage of how we route. But on any given order, we don't know where that order is going to go. Now, once the aggregator gets the order, so let's just say Citadel. Let's say Citadel gets that order. Citadel can then decide what exchange they're going to send the order to. I personally don't care. I've had customers say to me, well, I don't want my orders to go to a particular exchange. I have never heard what I consider to be a valid reason to say why they didn't want their order to go to a particular exchange. You might feel that way. I'm not going to tell you you're wrong. I just have never heard of a reason as to why it shouldn't go there. Once the order goes to the exchange, the aggregator has the ability to interact with that order. Let's assume that it's a marketable order. You're not sending in an order that's away from the market, either above or below. So let's say that it is a marketable order. The aggregator has the opportunity to interact with that order. What does that mean? You're coming in to sell something at a particular price that they want to buy, or you're trying to buy something and they're happy to sell it there. They then can say they're going to take part of it. They can take the whole thing. Now, there will be other market makers that will be there and say, wait a minute. Yeah, that order from Tasty went to Citadel, but we want a piece of that order. This is true. I know you're going to think this is crazy. They have an auction. So they actually have an auction. So I just said this whole thing happens in 200 milliseconds. The auction occurs in that time period where they can say, boom.
That's crazy.
Crazy. That's sometimes how you will see you got a better fill. Because somebody will say, they're trying to pay $2, I'll sell it at $1.99, you're filled. And it all happens literally in the blink of an eye. Now, why can an order, so Scott puts an order in and I put an order in. Same order. Different firm, could be the same firm. It could be both with Tasty. But why did Scott's order fill? Same order, same price, and my order didn't fill. Now, I get this, and I typically hear, because people are going to call it typically to compliment, although we do get a lot of compliments, I typically hear, hey, I have an account at ABC Farm. My order filled there. It didn't fill with you. What gives? And I'll say, look, a couple things could happen. The options market is a living, breathing thing. It's constantly moving. So while you say the order was put in at the exact same time, if it's off by a split second, market moves, maybe something happens, Scott's order failed, my order didn't. That's one possibility. Another possibility is that if it's, for example, a spread, typically that's where we find that people will say, hey, my spread filled here and not there. Exchanges. So exchanges don't expose a spread book, but they do expose a single option. So if you look at an option, let's say you're trading Apple and the market's $1.90 to $2. And you
are you talking about a single option or a spread?
Single option. Okay. And you go to pay $1.95. You will see that pop up. I don't care where you are trading if it's not filled right away. Let's say it's not filled. You will see that bid as being $1.95. You are now the bid. But spreads are not posted. Spreads are posted to market makers. Market makers can see the spread book, but we as retail, we cannot see the spread book. Now, you put a spread in. Let's just say you go into, it's a spread now. Scott goes in to pay $1.95 for a spread, and I go in to pay exact same thing, $1.95 for the same spread. My order gets routed to CBOE. His order gets routed to the ICE. He fills. I don't. What gives? Well, again, something might have moved, in a short period of time, possible, but more likely, the reason that Scott's order filled, mine didn't, is that his went to the ICE. The ICE just so happened to have a resting bid or offer for one of the legs on that spread. And they look at their book, they go, wait a minute, we have a resting bid, we have a resting offer. They go, boom, boom, filled. So his spread didn't fill as a spread. His spread filled as two separate orders. Now, when Scott sees the order come back through his broker, he will see that as a spread. So let's say it was $2. Let's say it was $3 over $1. He paid $3, sold it for $1. That's his $2. The reality of it is the exchange went boom, boom, lifted the $3 offer, hit the $1 bid, and Scott's filled. My order, which went to the CBOE, didn't have the single legs, so I didn't get the fill. Now, if you see this and you say, wow, I really think that I should be filled here, or I don't want to say should, I could be filled here, cancel, replace your order. The reason I'm saying to cancel, replace your order is cancel replacing the order starts that whole process over again. So again, I'm going to speak on behalf of Tasty. You now go back using our random algorithm, our random wheel, which then picks which aggregator it goes to. Then you get their wheel, and then it picks what exchange it goes to. So it's more than likely you're going to wind up going to a different exchange if you cancel, replace the order. Now, please, please, please do not sit there and just say cancel, replace, cancel, replace, cancel, replace, cancel, replace.
That's a great thing, because someone in the chat who's very active in our rooms just said cancel, replace, send, repeat, cancel, and I see that a lot when we see some of our students getting filled on something and others not, and then they will start going through to send it.
Please don't do that. Okay. Now, you might say, why? There's no risk to me to do this. And I wasn't planning on going here, but I will go here. This is really, really, really difficult to do. It's possible, but it's difficult. There is a notion that most people are unaware of in the retail options world, which is a professional designation, a professional trader. Now, professional trader is not for tax purposes, which it could be. You could choose to do that. Professional trader is not for data, because the exchanges all say that if you're trading in an entity other than a trust where the trustee is not compensated for their work, you are considered a pro. The CME at least says you have to be licensed, but the options exchanges, stock exchanges say, nope, if you're trading in an LLC, an S Corp, a C Corp, a trust where the trustee is getting paid, that's all pro. That's not where I'm going to go here. A pro from the options world, and this is really hard to do, but a pro from the options world is somebody who routes, doesn't have to fill. You send 300 on average, 390 orders a day for a month. 390 orders. I'll do the math for you. It's an order a minute. Wow. There's 390 minutes in a trading day. So if you send more than 390 orders on average a day for a month, the firm that you are trading with needs to change your designation when the orders are being routed from a retail to a pro. Why does that matter to you? The reason it matters for you is there's called retail preference, retail priority. Goldman Sachs, as a pro, could be trying to buy 10,000 calls at $2. They're the only bid. They've been resting there all day. Can't get filled. You, as a retail customer, go in to buy one. You go ahead of Goldman Sachs. That's an amazing quality of the options market.
What if the retail customer went in to buy the same 200 or whatever, the same amount Goldman?
Doesn't matter.
It's still going to have priority.
You go in to buy 10,000. Goldman was working that all day. As soon as you hit the confirm and send, your order goes ahead of Goldman because you're retail.
Got it.
Now, so you might say, well, that doesn't really matter to me. The other problem is your firm, we won't take pro business. So your firm might come to you and say, sorry, but we need to shut you down. If you are flagged as a pro, I'm sorry to digress on this, but if you are flagged as a pro, you are a pro for the remainder of that quarter plus the entire next calendar quarter.
Ouch.
So don't sit there, please. Just don't sit here and do this. Cancel, replace, cancel, replace, cancel, replace.
There you go. So the orders are, even if you're not filled, as long as the order is placed.
Correct.
Got that, everybody? That is something I absolutely did not know. So rinse, wash, repeat. Careful.
Again, doing that, somebody might say that doesn't seem like a lot. It's a lot. In the history of Tasty, we've had one person. We follow it. So if somebody gets close, we're in touch with them. But the people who usually get close monitor, and they know exactly where they stand. So anyway, continue. Scott, let me go on. I know we don't have that much more time left.
It's all good.
I hope this has been a good start.
I can tell you that everybody is just eating this up. So it's great.
Good. So it's important to understand that the firms, and again, I'm speaking on behalf of us, but I'm going to say the same thing for all the other firms. There's no upside to a firm not filling your order. So you could call and complain and say, why didn't you fill my order? And I could tell you for Tasty, why would we not want to fill your order? We don't make anything if we don't fill your order. We are in the business of making money. Yes, we are here to help you. We do bend over backwards for our customers. But at the end of the day, every firm wants to fill the orders because that's how they're making the money. So it's not in their best interest to not fill you. But having said that, firms need to know if the orders aren't getting filled. We monitor. We're very careful. We watch ourselves. All the firms do watch. But I think it's important to get called out every once in a while, because then we can go to the aggregators and go, hey, here's an example. And I love if you can, we get customers that do this. They'll send me, I got filled here. I didn't get filled here. Great. Send it off. We ship it off to the aggregators and go, explain yourself. And there's almost always a really good explanation as to why the order did not fill. But it's good. It is good to know. Now, something, if somebody's interested, and I really call this on the geeking out part of options, you can go Google 606 report for any firm, and that will tell you more than you're going to want to know about how they're routing their options, what they're getting paid for it, et cetera, et cetera. But it's interesting. If you got some extra time on your hands, you're a little bored, you've run out of streaming shows to watch, go Google a 606 report for fun and just take a look at it. Every firm has to post it quarterly, public out there. I would stay away from the 605. That starts getting into stock and it's a little bit too detailed. But the 606 is 100%. If you're interested, it's 100% worth just taking a look at. So that, to me, information is power. The more information we have, and I'm saying I'm retail, the more information we have, I think the better off we are.
Awesome. Now, let's talk. This is something that I would say most newer traders struggle with, and even many traders that have been doing this for a long time struggle with, is they enter in an order at the mark, at the midpoint. So the market is, $192, but they see that 195 as the price, and they want to know why they are not getting filled. We go through this all the time. Maybe you have a better explanation than I do.
Well, I don't know what your explanation is, but I will say this. I think that Tom and I really created that, or at least made it popular at Thinkorswim. I don't think mid-price was really ever a thing, that people would look at, because we really promoted and made spreads, what they are today. For example, I'm assuming you guys do iron condors. Iron condor was not a thing before Tasty. We created that. And we actually fought with FINRA, because back then, FINRA didn't know what an iron condor was. So they would require margin on both sides of the trade. So if you sold a $5 put spread for $1 and a $5 call spread for $1, they'd say you needed $4 on each side. We're like,
which makes no sense.
You're taking in 2 and you can only lose 3. So we fought with them for years, and that's where universal spread margining came from, was because of us and our work with them to say, look, this doesn't make sense. Now, if you have a call spread in one month and a put spread in another month, of course, you could be at both places. So what happens, the reason that when we did this and we really promoted the mid price is because customers would be like, well, I don't know where to enter the order. So one of the things that we believe is efficiency in markets. We believe that the market makers are correct in their pricing. In the options world, stock world, trading world, is the most amazing asset class in the world, because it's a two-sided market. Tell me something else in your life that's an asset that you have a two sides to. You can't. You could look at something and go, well, that house isn't worth what it is, but you can't sell it, right? You can't short the house. But if you look at a stock or an option or a future, whatever it is, and say, I think it's inexpensive or I think it's overpriced, you could choose to do something with it. Now, the mid price is nothing more than the middle of both the bid and the ask for what your options or 1, 2, well, not 1, but it could be 1. Obviously the mid price for an option, but for a spread, 2, 3, 4 legs. Why does it matter? Well, the mid price is really close to fair value. That's what you need to think of it as, fair value. Where a market maker would say it's a coin flip, it's 50-50. I'm not interested at the mid, but if you pay a penny over or sell a penny under, or pay 2 pennies over or sell 2 pennies under, I'm probably interested. So from my perspective, the one thing that when customers ask me, 100% of the time, I'm going to say the most critical aspect of trading is liquidity. That is it. Start and stop liquidity. That's it. Please stay away from illiquid products. Why? Totally. Whatever you give up to get in, remember, getting in, this is your choice. because as retail, we get to choose what we want to do. Whatever you give up getting in to an illiquid or any option, but I'm just saying illiquid is where the problem comes. Be prepared to give up more to get out. So to me, there's so many liquid products. Why do you have to go find something that's obscure and say, oh, this is going to be, this is where I'm going to focus? Again, if you have a strategy that works for you, congratulations, keep going. But if you find yourself pushing on a string, take a look at the liquidity of the product that you're trading. That's probably going to be your first red flag to say, you know what, there's no open interest, there's no volume. That should be word to the wise, move on. Now, one of the things that, and I said earlier, I'm not a believer in market orders. So marketable limit, for sure. No issues with a marketable limit. What's the difference? A market order is you hit market, meaning just give me the best price you're willing to give me. The key is willing to give me. Willing to give me. So you could go in, and on equities, it's very different because there's no MBBO on equities. So on an equity, it's even worse. And I've seen fills back in the day where you say somebody went in to buy 5,000 shares. They filled them on 100 shares. Here, they filled the 4,900 balance 50 cents to $1 higher when all of their exchanges were lower. That cannot happen in the options world. Because again, MBBO, they'd have to go to other exchanges. So if you're trying to pay $2, or let's just say the offer is $2, so you're trying to buy 100, and the exchange that you end up at the market, the exchange that you're on has 10. They will then sweep. It's electronic. I say, who else has 2 offers? We'll take them. If they can't fill your 100 at 2, they'll go to, if it trades in pennies, 201, 202, 203. If it's nickels, 205, 210, et cetera, until you're filled. Now, what is a marketable limit order? A marketable limit order, you want to buy 100 at 2, pay 202, or if it trades in pennies. If it doesn't trade in pennies, say I'll pay 205. That way, at least you say, okay, I can only pay 205. If you're still not sure about this and you don't know what that feels like, this is my analogy. A market order to me, because you don't know where you're going to get filled, would be like going to a cash station, taking out $500. How would you feel if you took $500 out of a gas station, put it on the ground, and walked around the block? Not good. You'd be going, I really hope my $500 is there when I get back. It's probably not going to be, but I hope it is. That's what a market order is. You have no idea. You have none. At the end of the day, especially if it's a liquid, you don't know where you're going to be filled. Stay marketable limit if you can. Marketable limit offers $2. You have 100 to buy. Pay, $205 if you have to on a limit. They can't just pay $205. They still have to fill you at $2 if $2 is available. So the other thing that I highly recommend is not just going in and lifting an offer or selling a bid, whether it's a spread or a single option. For sure on spreads, please do not do this, even if it's a relatively tight spread. Start at the middle. And I just finished saying, don't constantly hit cancel reprice. But this one to me is totally acceptable. This one to me, go in and say, the market, I think the mid's 195. I'm going to start at 195. Don't think I'm going to get filled. Hope I do. Go in at 195. If you don't get filled, give it a second. Penny it up to 196. If that doesn't fill, penny it up to 197. And then you could decide, am I willing to pay 198 or was 197 my limit? Versus if you just say, I'll pay $2 and they go filled, you're like, oh, good, I got filled. Well, you might have been filled at 198 or 197. Now, again, somebody might say, okay, it's a penny or 2 pennies. It matters. It really does matter over the long term to your trading success. So please be thoughtful. If you're going in, and Scott, I'm sorry if I'm contradicting anything that you teach.
No, it's perfect.
But if you are trading larger size, test the waters first. Don't just say, I'll buy 50 or 100 at this price. Try a 5 lot. See where the market is. And if you go in at the mid price and they go, boom, you're filled, you go, whoa, okay, maybe some option on the screen's a little bit off so that my spread, I thought the mid on my spread was 195. I'm going to try 190. Wow, I just got filled on 190s. Let me try 185. Okay, they're not filling 185. Now I know the real market is 190. You're not offending anybody when you do this. To me, that's called capital management.
For sure. I mean, that's listen, as we talk about all the time, everyone, this is supply and demand, right? So if you go in and you're bid on something, you're getting filled immediately. What does that tell you? That means there's a lot of sellers where you want to buy it. So lower that bid. Or, on the flip side, if you're selling something and it gets taken from you right away, that means there's a lot of buyers. Maybe you graduate that price to the upside.
That's right.
Question for you. Someone had put this question. This is a real good one.
Okay.
I have my own thought on this one, but I'm not 100% sure. So I just put this up here. Somebody sold a Vertex call for 80 cents a month out.
Yep.
They had an OCO order to buy it back for a penny.
Okay.
Expired out of the money by 20 points. The bid was still showing 0 and did not get filled expiration day.
Okay, so a couple things. Let me just look at I'm on my computer right now. I don't know if VRTX trades.
Does the OCO part of that have anything to do with it? Because that would mean he's okay.
No, the OCO doesn't. If it was a spread, the spread could. If you said, I want to buy, put in a call, and there was no bid for one, then that could have a problem. Here's the problem. So I'm not familiar with VRTX, but here's the problem for whoever asked the question. There are some options will only trade in nickels. VRTX looks to be one where you can only trade in nickels. You can put penny bids in. Some will take, if they trade in nickels, it's a little confusing. Some will take a penny, but they won't reflect it. So it's entirely possible that they took the bid, they won't reflect it. Now, why would somebody not sell that? Well, first of all, it's a great question. This is going to open up another huge area of confusion for customers. Most customers, and this is going to hopefully answer the question in a longer version, but if, let's say VRTX, what was it, the whatever the call was, it's 309. Let's just say it was the 420. I don't know. VRTX is 393. It doesn't make a difference. Stocks can and do move after the close. Why does that matter? Most people think, VRTX closed at 393. I'm short the 420 call. It's worth it. I'm good. Or worse, the risk department of whatever firm they're trading in buys that call back for a nickel. And they say, why? They call up and complain. And they say, why did you cover that for a nickel? It was $30 out of the money. Well, here's the simple answer. Stocks can and do move after the close. And unless you're trading in a cash settled index like the SPX, you could still be assigned, even though your option closed out of the money. So what it means is, and again, depends on what firm you're trading at. We give our customers an hour. I think we give them till 4:00 to send in exercise information, non-expiration day. But on expiration day, we have the ability to do something up until 4:00 where we can tell Apex, our clearing firm, Scott wants to exercise his 420 call in VRTX that closed at 393. Why would I do that? Well, VRTX or some company came out with earnings or some news. It's now trading 450.
We saw that Friday, and in fact, we're going to have a big discussion on this tomorrow. We saw it Friday with Robinhood and AppLovin, and actually MSTR markets were like that also, where the out-of-the-money calls were bid up big time at expiration with the anticipation of news coming out about them getting added to the S&P.
Correct. So our policy, and this is an art, not a science, but our policy is we buy back if somebody doesn't have the money to hold the stock. If you have the money to hold the stock, the resulting stock position, your clearing firm, your brokerage firm should not be covering your positions. But if you don't have the money, let's say you got $1,000 in your account or $5,000 and you're short a SPY call, we're going to say you don't have 60 grand, even a margin, 30,000, we can't let you take this. Our rule of thumb is typically 5x your net lick. That's what will let you take in stock on an exercise or an assignment. We will go in we have something, an auto liquidator that we use around expiration. If there is a penny bid for an option, we're covering it if you don't have the money. If there's no bid and it's at a penny, we'll typically leave them alone. But my question to you, and please think about this before you just quickly respond. Why not cover at a penny? Always. Like, to me, why do you even have that position on? So if you're not sure, you go, well, why would I pay the penny, the dollar? And well, we don't charge commission to close. Some firms do, some don't. But why would I pay the dollar plus the commission? Let me ask you this a different way. If you had no position on, would you sell that to open for $1? You're probably thinking to yourself, of course not. I would never sell it for $1. Well, but that's effectively what you've done. You've let that sit there because it's up to you. You could go pay a penny or 2 pennies, buy it back, take all your risk off, and you're done. Take your risk off, release your margin, go place another trade, or go sleep well at night, knowing that there was no risk. You're not going to come in tomorrow morning and go, oh my God, I'm short, 100 shares of VRTX up $30. How did this happen? Oh, I was short a call. I didn't realize I didn't cover it, and I just got killed. Trust me. See that? It happens one time. You'll never do it again.
See that, everybody? We preach that every single day. So you're speaking with two people here that have, a combined probably 80 years of experience of doing this, and that's a lot. And being in the pits and doing this and teaching you what real market makers, real traders, how they should trade. And that is why I always preach to you guys when we get near expiration or on expiration day, if you've got an option anywhere reasonably close, or even, farther out of the money, 5-10%, whatever it is, buy it back for a penny.
You can only make a penny. Remember that, or 2 pennies. You can only make, that's left. That's all that's on the bone. So it is when at Thinkorswim, we created the no commission if it's a nickel or less. We created that. Why did we do it? Because I heard too many customers saying, I don't want to pay the commission. And we're like, you know what? Great. You're not going to pay the commission. Buy it back for a nickel or less. We're not going to charge you anything. What that does is it frees up it takes your risk, completely takes your risk off the table. And again, you can either sleep better at night or go use that money and say, great, I'm going to go put another trade on, because what's left you can only make the nickel, or you can only make the 2 cents. So if there's anything that comes out of this conversation, let it be that. Well,
risk management, everybody, first and foremost.
Yep.
Well, Scott, this is, as I don't know if you're following the comments here in the chat or not, but unbelievable. I mean, this is what they asked for. This is information that is absolutely priceless. So,
well, I appreciate it. And if anybody has my pleasure. If anybody has any questions, it's Scott at Tasty Trade. I know Scott knows way more about options than I do. Yeah, you do. So if you have a specific options question, you're going there. If you have something about Tasty, reach out to me. Or if you just have a question about the markets, like, look, Scott just said he's been doing this for 40 years. He didn't know what the 390 rule was.
That's right.
So I've been on basically all sides of this business. So I do have a wealth of knowledge, and I answer my own emails. Want to ask me a question? I'm happy to get back to you.
Thank you for that. And so one thing we do to wrap up the show every day is, while you were talking today, we always have a word of the day.
Okay.
That people can enter in, and then it goes on this wheel, and we spin the wheel, and whoever the winner is gets some swag. So today's word of the day was tasty. So anybody that had put tasty in the chat are on this wheel here. So we're going to give this a spin now, and some random lucky listener is going to win some swag.
I love that.
And today's winner is Bear, Bill, or Brad. Bill 8575. Are you in the house still? They got to be in it. They got to stay around till the end, till we spin to win. So I am
not looking good for Bill.
Bill, are you in the house? Give us a shout out in the chat here and let us know. There you are. Yes, sir. Yes, sir. Maybe I'll even try and strong arm Scott and Tom to get some tasty swag to hand out.
We would be happy to. It would be a pleasure.
Awesome. Again, everybody, thank you so much for being here. Keep bringing the questions here. Scott Sheridan. I mean, this, again, like I said, this is priceless, amazing. Thank you so much. Appreciate all you guys do.
My pleasure. Have a good day, everybody.
You too.
Yeah,
See you
bye.
tomorrow, everybody. Have a great one.